Hello, this is the Unemployed Value Degen. I'm here today to go over some of the technicals for the stocks I've been covering. This is coming out a few days late. I didn't record one over the weekend because with the tariff fears, it felt like the market wasn't moving in a predictable way. But now that things have settled down, let's see how everything looks. Now the 10-year Treasury has finally been coming back down from its recent peak, and it's been giving everybody just a bit of relief. And I wonder now, if it doesn't jinx it, if the 10-year Treasury is going to behave in some kind of a nice, predictable channel, maybe something like that. If that's what happens, that it bounces around this channel, gives us a chance of seeing a 3.5% 10-year Treasury sometime in 2026, within Trump's first 2 years. A 3.5% 10-year Treasury gives us a shot at maybe a 5.5% 30-year mortgage. And I think that's the threshold that would really cause things to accelerate. All the consumer discretionary stocks. So that's what I've been watching for. So the things are feeling a lot more bullish now for me, that we're down from this peak, and hopefully that isn't a fake out. Hopefully there's some momentum there. About a week or two ago, Stanley Druckenmiller said that the Treasury short position, it wasn't over, but it was in the 7th inning. So he thought there was still a ways to go for the Treasury short position. But if just coming down off the peak enough causes the other Treasury shorts to close their position, well, all that buying will keep the momentum going right in that channel. Hopefully, we'll have to see what happens. But this is providing some nice support for the stock market, and the dollar index is starting to weaken some. So we're down off the peak for the value index as well. And I had been drawing a channel, maybe about here, that we had kind of broken out of a little bit, but maybe we're going to come back in. And if that recent peak was really just a bunch of momentum traders shorting the Treasury, and it's not indicative, there's just so many macro gurus out there saying that Trump needs a weaker US dollar, and for his manufacturing resurgence, to support exports, for blue collar hiring. And if they're really right about that, I wonder if this period of US dollar strength is about to reverse to the downside. And I think it was toward the end of 2024, I told everyone when we hit this point, just buy something international. And I was buying PagSeguro, which kept falling, and I bought Ecopetrol, which kept falling. But a lot of those have caught a really nice bounce this last week. The fear and greed index has us, still in the fear area. And coming off of, so we had that sort of Monday shock with DeepSeek for artificial intelligence. And now we've had the Monday shock for the tariff scare. But the market definitely has a lot to worry about, which is nice because that provides buying opportunities. And yeah, so in December with that value sell-off, that was the last time we were in extreme fear. But the market hasn't been able to break back out into greed for a couple of months. And I mean, this is the 4th industrial revolution, right? We're in this artificial intelligence revolution, and the market just can't get greedy right now, which I think is nice because it means there's room for things to buy. If we look at the components, the breadth, right? The breadth has been really challenged with the Magnificent Seven. We haven't entered a period of really strong breadth in a while. I hope that's not reversing, but we'll see. The put-call ratio, it's still been pretty suppressed, so people are still buying more calls than puts. And the VIX, with all that tariff fear, the VIX didn't really get past 20, which is kind of surprising. In fact, the VIX hasn't had a spike since Jerome Powell came out hawkish in December. Right, that was what triggered that 14-day value sell-off. So we haven't seen a VIX above 20 since December. Yeah, it's to me, anytime the fear and greed index is in the fear range, there's always something to find to buy in the marketplace. And so it's when things get into the greed and extreme greed that there's not so many buying opportunities. And this I thought was interesting. So this is the 1 month Morningstar style box. And I'm mostly living here in small cap value. But for this month, we've had a strange pattern. Large value and small growth are what's outperforming. So large cap growth, right, the Magnificent Seven, are not the ones leading the market for the last month. There's been a rotation, but not the rotation I wanted. It hasn't been a rotation to small value. It's been kind of a flight to safety to large value. Oh well, can't have everything. Right, and then into some charts. This is the S&P 500. It's still well behaved. Maybe I'll zoom in a little bit. Right, so, not 3 years, 3 months. Okay, so again, this is that value sell-off into December. The S&P 500 has been really well behaved. It hasn't really been breaking down too far below the 2 standard deviations from the 20-day moving average. Right, we had that Monday fear from tariffs, and then before that we had this is that Monday of DeepSeek, and now this is the Monday of tariffs. But you know, all in all, not too terrifying. Right, this is a pretty aggressive chart. It's right back on its 50-day moving average. I think the market just wants to go higher. Let's see, but the Mag 7, the Round Hill Big Tech ETF, not looking quite as aggressive, but there's one component of that everybody started to pay attention to, and this is NVIDIA. Now NVIDIA, it had this period of consolidation, but on the DeepSeek news, right, it broke down, and it's been spending maybe too many days below the 200-day moving average. That is not a super bullish chart. Now personally, I had predicted that the mega cap tech, that the big tech, NVIDIA included, probably has another couple years to go on this rally. But I'll be curious to see if NVIDIA stays part of that Magnificent 7 or Magnificent 8, or if there's going to be a focus on some other names. But this is some serious weakness in one of the market leaders, and it's very interesting. I don't have a position in NVIDIA. The only data center build-out stock that I have a position in is Applied Optoelectronics, and I think this is still in a bull flag pattern, right? So here's that rally upward, and here's a consolidation, and then it's just going to get ready for the next breakout. So I think Applied Optoelectronics is in that bull flag pattern. It has not been very poorly behaved, right? It keeps bouncing off that 2 standard deviation lower Bollinger Band. This is still a pretty healthy chart to come up from, you know, $8 to $42, and to give some back down to 24 or 27 is all very reasonable. But that is not the story of NVIDIA, right? NVIDIA, if it spends too long below that 200-day moving average and the momentum traders start piling in, I mean, this company is trading at such absurd multiples, so we'll have to see. I'm not trying to grave dance on anyone. It also wouldn't surprise me if it regained some positive momentum either. Let me take a quick look at the value factor. So the value factor, this is that 14 down day. This is so brutal. But it bounced off the 200-day moving average. It climbed up to the top of the Bollinger Band, and now it's right on the 20-day moving average. And it looks like the 20-day moving average and moving higher. It's a little bit below the 50-day, but I'm not so worried about that. So it looks like a decent time for the value factor generally, and that's what the style box has been saying, right? The style box is saying value is doing all right, especially large value. So this IVE ETF That's the S&P 500 value ETF, so that's exactly what they mean, large value. If I go to the RSP, which is the equal weight S&P 500, it's about the same graph. And then if I go to the Russell 2000, because I'm a small cap value degen, this one's a little less bullish, but not so much. It's still hovering right around the 20-day moving average. What's interesting here is this level that it's been at. Let me go back out to 5 years. What's that expression? The bigger the base, the bigger the breakout. This thing has been at this level, right? This resistance level, right around, what is it at? $220 a share on the Russell 2000. This is since January, February of 2021. This has been quite a resistance level for a very long time. You have that phenomenon where past resistance becomes future support. So now that we're above this level, maybe this is finally the base that it's going to bounce off of. But it's been a long 3 or 4 years there. Yeah, so yeah, there's that. So continuing that line that was there before, it was right about here, give or take, that went back so many years. So again, past resistance, it was hitting that as resistance. Now that it's above it, it's been hitting that as support. So I like to think that it's going to be a pretty good time for value and for small caps this year. And value and small caps are due for a good year. They haven't had a lot of good years, but there's been so much momentum from index buyers. It's one of those questions, if you can't beat them, join them. You just is the smart thing to do just to buy the S&P 500. I mean, speaking of good behavior, this thing doesn't even come close to its 200-day moving average all throughout this year. How far do we have to go back in time to see it even come close to the 200-day moving average? What is that? 2023. So those lows in 2023 that crossed below the 200-day moving average, it hasn't touched that in a couple years now. It's pretty amazing. So I can definitely see why people are interested in just owning the S&P 500. It does make sense. So today, usually when I have Mitch on the line, and he's better at technicals than I am, I look at stocks that I might be interested in adding to, but then I always get a few questions. Oh, how come you haven't talked about some of the names that I'm more bullish on? And it's because my position's full and I can't possibly buy anymore. So today I want to talk about some of the stocks where my position is full and I can't buy anymore. And the first one of those, this is my largest position, Medical Properties Trust. And it has been fighting to grind higher. Now in May and in September, when it reached a certain point, there was a short squeeze up over $6 a share. And I mean, it looks like it's getting to that point where the shorts have to cover and will cause this thing to spike. I mean, I have a full position. I can't possibly buy anymore. But you have it, again, just breaking above its 200-day moving average. You did have a death cross back here in December with the 50-day move below the 200-day. But this rally, just since the beginning of the year, it's been an aggressive rally upwards from, you know, $3.50 a share up now to $4.70 a share. And it didn't do that in July. When it did that in May and when it did that in September, it caused a short squeeze. And there's been so much positive news about this stock. So they successfully refinanced $2.5 billion of debt. It was a higher interest rate than I thought they would get. It was, I think the average, so the weighted average, I think, is 7.88% for $2.5 billion. And that is a painful interest rate, but it's a survivable interest rate because they have their, if you're just basing it off of the book value of the company, this is a hospital REIT, a real estate investment trust. A lot of their older properties, as the rent escalates with inflation, they have a 7 or 8% yield to book value on that. And the company's not really over leveraged. They were doing asset sales last year and they've slowed down on the asset sales. I don't think they need to do any more asset sales to get to the right level of leverage for them. But 7.88% is not a fantastic interest rate. some of the shorts on Twitter were saying, oh, they were going to refinance at 14%, which was absurd. But this company has no concern about any debt maturities until, I think, through 2026, maybe the end of 2026, with that it's 2027. They do still have one tenant going through a bankruptcy process, but it's a much smaller than their steward. And now it's just a world where the news that comes out, it should be increasing rents, right? They had 15 hospitals that they received back from steward through that bankruptcy process. They have temporary tenants in there, and they should be on half rent in 2025 and full rent in 2026. So it should be a world where you see rents going up, dividends could potentially increase. There was a debt covenant restricting the dividend to 8 cents a share per quarter. I don't know for a fact, but that covenant expires in September of this year. But I believe the debt that covenant was tied to was repaid in January. So I could be wrong. That covenant could be attached to other debt as well. But you could totally shock the market on the next earnings call, and they could announce a bigger dividend than 8 cents a share. So yeah, that's some pretty strong price action. It's been really just staying right at the top edge of that Bollinger Band. It bounced back to the 200-day moving average and is grinding higher. And the short float on this thing is so huge. Let's see, just navigate away from that just for a moment. What is the short float on this stock? I think it's one of the most shorted names in the market right now. And if I was a short, I would be scared. Short float, 44.58%. What is this? Yeah, and the short interest has been pretty much only increasing all over the last year, despite how many fundamental things have been improving. But that's 19 days to cover the amount of, so just on average volume, I believe the short ratio is how many days to cover all of the shares short. I could be wrong. Average daily volume, 12 million. And then the short interest is 230 million. So yeah, that's getting pretty close to 20 days to cover the short interest. And this is still, it's trading at 53 cents the tangible book value. And I'd be looking for this stock to return to about 1.2, $1.20 to the dollar on tangible book values. There's a lot of upside, but those short squeezes, they're violent, right? So on this day, May 13th, it opened at 481, it hit 630, and it closed at 558. And then on September 12th, opened at 550. This was an interesting day, but then the day after opens at 583, high of 643, close at 637. So there was some pretty aggressive two-day short squeezes there, and I'd have to imagine we're getting close to one of those. Although today's candle wasn't so amazing. Let me make this a little shorter. Yeah, so as I say that, today's candle is an inverse hammer candle, and that's a sign that, you know, the stock initially climbed higher, the buyers got exhausted, and the sellers took over, and they brought the price all the way back down to where it opened at, and that can be an indication that the buyers have lost control, that the buyers are exhausted. It's not always. There was an inverse hammer handle there, and it spent a couple days down. But this is a pretty aggressive run-up since the 13th of January. So yeah, I'm very excited to see this because I'm not buying any more. This is my largest position, but I think it's, you know, it's on its way back to $10, $11, $12 at some point, and I would enjoy a massive short squeeze. All right, let's look at New Fortress Energy. New Fortress Energy, that's hasn't been friendly in the last month or so, but that's, you know, same as before. That's about what you'd expect from a bull flag, right? So there's a giant rally up from $8 all the way up to 16, and now it's consolidating. That doesn't doesn't really bother or concern me much. It hasn't been the most painful consolidation. It's down to $14 today. I don't know when it's going to finish consolidating and break out again, but it had some positive news. So they did get a new contract signed in Puerto Rico. So this was an interesting one. Puerto Rico got its first Republican governor, I think, in Puerto Rico's history as a U.S. territory. And in her acceptance speech, mentioned natural gas power plants specifically to stabilize the grid. And New Fortress Energy is the big player for importing natural gas into Puerto Rico. I mean, their electricity costs were so high. There's a big chunk of the Caribbean and Latin America that burns essentially heating oil for electricity. And it's so expensive to do that. So having U.S. natural gas being able to be shipped to Latin America is a huge business opportunity. And the New Fortress Energy is going to have a lot of capacity coming online and a lot of new long-term contracts coming in or starting. So they sign a long-term contract, and it takes years to build out the power plants and to build out the import terminal. And a lot of those are happening in 2025, finally coming online. There's Barcarena in northern Brazil. I think it's Nicaragua. So Nicaragua and Barcarena are both, I think, ramping up this year in 2025. So anyway, I'm a huge fan of New Fortress Energy. I wrote about it here, and then everybody grave danced on me after I wrote about it at 25, and the stock price collapsed. But it'll be back there. I'm not worried. It's a fantastic business. And then, so Finance of America. This one, it's about a 9% position for me as far as the portfolio concentration. This one, even though it's such a large position, I still would buy more. And it looks like it's been giving a little bit of an opportunity to do that. So again, it's same as the other charts. You have this bull flag where you have this incredible run up, and then you spend some time consolidating, right? And that's that traditional bull flag pattern. Now, how long is that consolidation going to last? Nobody knows. But and personally, this next earnings, I wouldn't be surprised if this next earnings call was ugly, because all of these financial firms have mark-to-market losses that it's not a cash loss. It's just by generally accepted accounting principles they have to mark things a certain way, and the market could get spooked by that. So with those rising interest rates last quarter, I think there could be some mark-to-market losses, and I think that could spook the market. So I want to buy more. I want to sell some puts on it too, but I'm kind of holding off until after earnings. But if earnings come in strong, if they have another $175 million upward adjustment to book value, then the price will just go into the stratosphere. It'll break through the past highs and go crazy, because that's what happened before. Was the earnings call? I forget which one, but the earnings call with $175 million of mark-to-market increase to book value. So my guess is this upcoming earnings will be bad, and the one after that will be really good. I don't know that for a fact. It's and I could be totally wrong, but I want to buy more, and I'm hoping for a breakdown on next earnings so that I can buy more at cheaper than this, but it's hitting some key resistance levels. So it's currently at, right, you have, let's see. Yeah, so the 200-day moving average is way down here at $12.73. But the 50-day moving average, so the stock just dipped below the 50-day moving average just for these last 2 days. So that is a resistance point. It could start grinding higher from here, or it could stay in this consolidation channel. I don't know when the consolidation period of the bull flag is going to break. I think it could have a couple more months going sideways. We'll have to see. But unlike the other ones, this one I still would be adding more to. My next largest position is Transocean. And this is an ugly, painful chart. It still has this long-term downward trend line. it's kind of too early to say. Right? So here's, maybe this is the pattern of lower lows. Maybe we're out of the pattern of lower lows now. Maybe the new pattern started, you know, something like that. Maybe this is a new trend line, but we don't know because it's too early to tell. So this is an ugly, painful chart. It's, you know, barely able to touch its 200-day moving average. It has been bouncing off of its 50-day moving average and staying below that most of the time. Things are not looking good for Transocean, and I think there's a couple reasons for that. One is contracting has really slowed down for offshore. Some of the day rates have even fallen a little bit, although there's still, when I started buying this company stock, the day rates were around $200,000 a day. Now they're 8th gen, they have some contracts signed for $650,000 a day. So, and even with their backlog of contracts, they've got a pathway now to being cash flow positive, I think in 2026. But one of the things that's really dragging the stock price down is the rumors of an acquisition of Seadrill. And Seadrill, because Transocean stock price is so low, a stock-based acquisition would cause too much dilution. And it would have to be a stock-based acquisition because they don't have the cash to do it. Fundamentally, I think it would be a good acquisition, and you spread their debt over a much larger fleet, you get some economies of scale, you get more market power. So fundamentally, I don't think it's a bad acquisition, but the dilution that it would take would be huge. Now, Transocean has a much better backlog than Seadrill. So if offshore stays kind of struggling for their year, maybe Seadrill's stock price will come down based on its limited backlog and some white space, that stock-based transaction would be attractive. Or the prediction is 2026 is going to be a big year for offshore capex for the super major oil companies. But those contracts will have to be signed sometime in the middle of 2025. So if we get to the summer and it's just, you know, contract after contract after contract at higher day rates, I think the offshore market will pick up again. But I think this is the Seadrill acquisition weighing on it, because the other companies, if I look at Valaris, Valaris, it looks a lot more clear that maybe the downtrend is over. And there's Valaris falling from $80 a share down to $40 a share. So Valaris got cut in half between August and January. But it looks like it's climbing back out of this. And again, the difference is that they don't have the debt and they don't have the acquisition hanging over their head. And how is Noble looking? Yeah, Noble fell a lot less, and I think that's because they pay that dividend. Dividend paying stocks, they tend to have a lot less volatility in that. And this is the one, so for myself in my portfolio I have Transocean. In my wife's Roth IRA I put Noble while it was down here at an attractive price. And just when my wife's looking at her Roth IRA balance, she probably would not appreciate volatility the same way that I would. I think it was a pretty good entry price, and the dividend won't hurt at the same time either. And she doesn't have to pay taxes on those dividends. So yeah, I don't think you could go wrong with any of the three offshore names. I think the offshore cycle is intact. I don't think that thesis is stretched at all. But I do think Transocean has that overhang from the Seadrill acquisition that everybody seems convinced is going to happen. It might or might not. See, my next largest is ProFrac Holdings, ACDC, and that had quite a day. So this has been chopping sideways in a really aggressive channel. In the last year, it's been between 550 and 950. So it's been, you know, from 6 to 9, from 9 to 550, from 550 to 950 again. This is a lot of chop, and fundamentally things have been pretty bad for onshore oil services. You know, we've been in the down part of that cycle. Let me just go ahead and show you guys the frac fleet count, because the frac fleet count is harder to find than the rig count. Here we go. So this is the frac fleet count, and it's been on the decline since the end of 2022, and a pretty sharp decline. And then you have some seasonality with the polar vortex, the freeze. And just last week, for the first time in a couple of years, the frac fleet count started rising again just last week. It's too early to know that that's a trend, but we might be through the worst of this onshore fracking services downtrend. Now, ProFrac's management guided that the fourth quarter, their upcoming earnings announcement, is going to be pretty weak. But they guided for a strong and growing 2025. So I'm pretty bullish, but this has been just a lot of violent chop all year. So yeah, and had a pretty amazing day today. I think it's, and this is one of those ones that, I mean, check out the price action on the day that the election came in, when Trump won the election. It's had this enormous November 5th price action, enormous November 5th price rally. So I think people know that as far as drill baby drill goes, they're kind of unsure about what that's going to do to the oil price, but they're pretty sure that volumes are going to be higher. And if volume, and also with the natural gas export terminals coming online, between the natural gas export terminals coming online and a government that's trying to push for drill baby drill, ProFrac Holdings should be a huge beneficiary of that. But I mean, no clear direction, just lots of chop, a lot of volatility. I mean, crazy volatility. Okay, Vermilion Energy. Now this one has been suffering by being a Canadian stock. I mean, they did an acquisition that the stock market didn't hate. The stock market was kind of indifferent to their acquisition, but it was particularly hard hit with the looming threat of tariffs and also the strong dollar. But what's interesting about Vermilion Energy is they have, it's less now after the recent acquisition, but they've got a solid chunk of their cash flow that they're making in Europe. And Dutch TTF gas prices have been pretty high all winter, and the stock price keeps going lower. So this is a stock that they've done share buybacks, they've been increasing their operational cash flow, and the stock price just keeps falling. It seems pretty sideways since August. If I had to describe this, seems like it's been in this same channel since August, give or take. And the question is, when does it break out of this? Somebody was sharing some data. They were manually estimating the share buybacks, and I don't want to jump ahead, but I think on the next earnings call, Vermilion might announce that this last quarter they bought back something like 5% of the float in a quarter, which is just aggressive share buyback. But when you compare their market capitalization to their cash flows, they absolutely can do it. I mean, they have such enormous cash flows for such a low market capitalization. So we'll have to see. I mean, it's been painful, but this is one of those things that's been falling or chopping sideways for a year. But you know, when it finally gets some momentum, I think this will, you know, I think the run up to $30 or $40 a share will go pretty quick once it starts getting a little bit of traction. You also had the threat. So part of it was Justin Trudeau's threat of a capital gains tax increase really affected the Canadian stock market. And then oil prices affected the Canadian oil companies, and then now threats of tariffs. It has a lot of geopolitical things that keep the stock price suppressed, but at some point those are going to stop weighing on it so heavily. But nothing in the pattern there that's so amazing. Let's see. Well, those are all the positions that are so large that I couldn't possibly add any more. The rest of these are positions that are large, but happy to add more. Now, Portillo's has just been aggressively trying to break out of its previous support. Let me go back a couple of years and see where the resistance lines are. So you have this one at 14, and it's above that. Don't know if it'll hold, but how big of, oh yeah, so that That's a pretty good resistance line. So it touched this 14 level October 2023. It was a pretty good resistance level. Maybe I have to bring this up just a little bit. But yeah, this resistance level, maybe not quite there. No. That one. That one. So it looks like, and I'm going wild with crayons here, I'm trying to figure out if it has broken above this major resistance level at $14, and if it breaks out of that and it confirms above that resistance level, you know, it could have another resistance level at about 15.5. It could have another resistance level at about, you know, 16, 17. But this has definitely got some positive momentum, and I'll go ahead and leave the annotations and go back to the 1 year. But this has been some aggressive price action, and it's not really giving much time to consolidate before it keeps on breaking higher. So one of the reasons for owning this is just because they have, you know, a nice 20-30 year runway for growth. But the hope is not just the organic growth, but also the multiple re-rating, and how to convince the market that this is the next Chipotle. And it was really kind of fortuitous that they were able to get the chief strategy officer from Chipotle. So if you're trying to convince the market that you're the next Chipotle, I think getting Chipotle's chief of strategy to join your board of directors is a pretty good way to do that. So once the narrative changes from, oh, this is a Chicago brand that has a Chicago attraction, to that this is a nationwide brand that is just loved by everybody who tries it, has a huge net promoter score, you know, I think that's, yeah, it looks like this $14 range was the resistance, and maybe we've broken out of that, so we'll have to see. If it breaks out of 14, it could be, you know, quickly on its way to 16 or 17. But this one, a lot of that's kind of a moot point because I'm holding on to my shares, I don't know, for decades and decades and decades. They're growing their store count, I think 11% this year. And they did 11% store growth last year, but it was almost all open in the fourth quarter. So we'll have to see how the results come out on earnings. But I'd love to see those Chipotle multiples, because that would be fantastic to have Chipotle growth and Chipotle multiples. So yeah, I had sold a put, I think about $12.50. I don't know if I would sell a put at $14 or $14.50. I might wait for another dip to do that, but I might not get one. Sibanye Stillwater. So Sibanye Stillwater has had a really nice few days, and I don't know, it's even above $4 again, which it hasn't seen since last year. I don't know why. So palladium and platinum prices are still down. But maybe the gold price at $2,800 an ounce is high enough. I mean, this company at $2,800 an ounce gold, and I think they're South African, they only release earnings every 6 months. Last time they did that, a sixth of their EBITDA came from a zinc mine that they had acquired in Australia that people had completely discounted. And this company, so I'm kind of a sucker for the conglomerate discount. I find stuff that's so cheap because it's got that conglomerate discount, and then maybe it stays cheap, but at the same time, they had acquired a zinc mine in Australia, and right after they acquired it, had a once in 100-year flood, and so people kind of forgot about it as an asset. And last time they released earnings, a sixth of their EBITDA came from the zinc mine, and now with gold over $2,800 an ounce, and this company owns not just their own producing gold mines, but they have a 50% ownership stake in a tailings processing gold company called DRD Gold. And that might be responsible for the recent price strength. But you know, that's a pretty attractive little breakout. There's a lot of resistance points. You know, there's a lot of places where it could start hitting its head and failing, right? So that's one. Maybe that. Yeah, maybe that's one. I mean, there's a lot of places where it could fail. But it's nice to see it with a 4 handle in front of it instead of a 3 handle for the first time in a couple months. let's see. Speaking of the gold miners, I think this move to $2,800 an ounce in gold surprised a lot of people because Equinox Gold broke up to $661, and I think this might be a new. Let me go out and give it 3 years. Is this? Yeah, so I think Equinox Gold might have just poked its head above. Yeah, so Equinox Gold just poked its head above resistance because the resistance was down here, a little bit lower than where it is now. So that's fantastic. I think the consensus was that the gold price would move sideways or maybe even fall in 2025. And it's not doing that. The gold price is still grinding higher. It reached a new all-time high. It's closing above $2,800 an ounce. And that's fantastic for gold companies. So that's Equinox Gold breaking above past resistance lines. I don't know if it's going to maintain that momentum, but we'll have to see. Douglas Eliman. So Douglas Eliman has been showing a little bit of positive momentum here. So this is going to be interest rate sensitive, and obviously when the interest rate was peaking, right? So go back to this 10-year interest rate. So what was the peak of this thing? It's peaked on January 12th, and it was really panicking everybody as it started climbing. So this is the Fed's interest rate cut in September, which was the low, and then it's been climbing ever since that interest rate cut. So this, anything interest rate sensitive is going to feel the panic all throughout November and December, and that's what we have here. So it has a real crash starting at end of November while value is selling off. But now interest rates are falling. You know, the 50-day is above the 200-day. It's pushing up against a little resistance there. I'm not going to say it's the most bullish chart that I've ever seen, but I still like it. I'd be willing to buy some more of this. I think I wrote about it and I bought some of my initial. I think I got it in at like $1.09, so somewhere around here. But I've been meaning to buy more, and I just haven't been able. I've always had something else that I wanted to buy more, and yeah, this thing could start breaking out and get back towards $2.50, $3 again. I don't think there's anything that's going to stop it because, well, if you check out my paywalled write-up on my Substack, with this company, there's a lot going on in the accounting statements. They have deferred revenue, and deferred revenue is this weird thing that when a store sells a gift card, they receive the cash now, but it shows up as a liability on the balance sheet because at some day somebody's going to come back in with that gift card and demand some goods. Now, Douglas Eliman is a real estate broker. They've been focusing on new build condominiums, which take 4 or 5 years to build, but they get half of the commissions when the customer pays a down payment. But then it still shows up as that deferred revenue as a liability, even though they're not the ones building the condo. So now they started that procedure about 4 or 5 years ago. So that first batch of new build condos is getting delivered now. So for 4 or 5 years, you have these liabilities growing, and you have costs that are not associated with revenue because there's going to be another second half of that revenue arriving when the condos are delivered. So I think the financials are going to start looking better, even if the market is under pressure with interest rates. That's Douglas Eliman. TWI Titan International. Last time we looked at this, the breakout was not so convincing. This time it might look a little better. So where would the resistance level be here? Is that a resistance line? Maybe. I don't know. I feel like this one is has the ability to break out above this range where it's in now. They just announced, so that I think the stock price sold off on an acquisition, but they announced a new contract to be a global supplier for a part for some certain types of parts for John Deere. And I'm sure it's going to take a while before revenue flows through that, but it's a very bullish thing when you get such a huge contract like that. Heartland Express. Yeah, this is the one that, so logistics haven't ticked back up yet. Logistics are still suffering. But a lot of the fundamentals for logistics are still going. So on the ground, the tender rejection rate has been strong. There's a lot of things for logistics that it should get recognized at some point as a Trump trade and should start having some positive momentum. But for right now, the stock price just isn't hearing any of that. So Heartland Express still has, I think, still has some time to accumulate before it moves. That was Abacus Life. So sometimes when I write about a new stock and I need to own it, I'll buy it without waiting for the technical confirmation. This is one where when I discovered the stock and I wrote about it, I bought it immediately. The technicals are not amazing. You have the death cross in August where the 50-day moves below the 200-day. And this stock price could be struggling for a while. And the multiples, so they've been growing aggressively, and so it has some kind of growthy multiples. The multiples could compress more. I had to buy it. I had to at least start a position when I wrote about the company. Alta Equipment Group. So this one, not much positive to see there. And I always compare that one with Custom Truck One Source because they're very, very, very similar companies. And Custom Truck One Source is a much more positive, a much better graph from a technical standpoint. So Custom Truck One Source probably still the better one. The difference is, so Alta Equipment Group has construction equipment. It's a dealership parts and service model. Custom Truck One Source does equipment for construction, but with a heavy focus on electric infrastructure equipment. So all of those, when Florida had those hurricanes, you have bucket trucks drive in from all over the country. Actually, my 2-year-old absolutely loves bucket trucks. So we went and talked to some of the drivers in one when they were at the grocery store. And they had driven to Florida from Arkansas. So after the hurricanes, you have the bucket truck crews come from all over the southeast of Florida to put the power cables back up. Custom Truck One Source is a dealership that sells, leases, services, and sells parts for that type of truck. Whereas Alta Equipment Group, they do forklifts primarily, but they also have construction equipment, and with an acquisition in Canada, they even have some mining equipment. But it's still like a car dealership, but a equipment dealership for construction and manufacturing equipment. So Alta Equipment Group is going to be much more exposed to the reshoring of industry, which I think is still early. I think you're going to need to be a little bit more in the Trump administration before you really see that start to take off. Oh, now for a painful one. Peabody Energy. So Peabody Energy, I don't know what the low is going to be. Let me zoom into this a little closer. It had quite an up day. It was, I think, start of the day. Where did it open at? 1710. And then it closed at, where did it close? Does it not tell me here? Closed at 1821. So it had a high of 1828, closed at 1821. So it was up over $1 today. I don't know if this is the end of the decline. The market is telling management that they really, 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 really hated that acquisition. And I think that's fair. When I did my write-up on that acquisition, I didn't really take the full weight of Australia's tax and royalty system into account, and especially where it, so Australia has this escalating royalty system. One of the things about these cyclical commodities is they make all of their money when the price squeezes. So you make all your money in 1 year out of 6 or 7. And by doing that huge acquisition in Australia, you know, that 1 year where metallic coal prices squeeze, they don't get to keep a big chunk of the money because the Australian tax system is going to take it on that year when the price is squeezing. So the market really hated that acquisition just with a burning passion. The old motto was, you know, that $18 a share was kind of the floor for Peabody Energy. And then we went through a whole year where people were saying, 22 is the new 18. And after that acquisition, maybe 18 is the new 18 because it didn't really stay below $18 a share very long. So maybe 18 is the new 18 again. So maybe the bottom is in for Peabody. This is an aggressive sell-off from $29.50 down to $17.10. And you still have the thermal coal, right? You still have the electricity power gen demand, not just for the data center build out, but also for reshoring of industry, also for the electrification of everything and all these electric cars and things like that, and electric trucks, electric Amazon Prime delivery vans and things like that. So I don't know. I don't count them out for down and out. I think the bottom might be in now. There's no technical confirmation of that, but just one day bouncing off the bottom. It was a very strong bounce though. Yeah, from 1710 to 1821. That is a huge green candle for Peabody Energy. They did have another one of those last month, and that started a little bit of a rally, but it failed and made a lower low. But at some point it's just too low of a market cap for how big of a business it is. Let's see. Already applied Optoelectronics. Let me check out ARS Pharmaceuticals. So that one broke down hard. It was having this really nice uptrend, broke down hard. The 50-day didn't provide any resistance, but the 200-day did. So having bounced hard off of the 200-day here, this might be a really good entry point. The last couple times we talked about it, we said, yeah, it's on an uptrend. You're not buying the bottom. It's not an amazing entry point, but probably still buy it anyway. This one might actually be a good entry point, right? This might actually be that, because also you have a 50% retracement. A lot of times in an uptrend, if you take this from 10 to 15, well, 1250 is exactly a 50% retracement. So that would be just a continuation of a bullish pattern. I was surprised to see it sell off so hard, but it's behaving well if it bounces off the 200-day moving average, which it looks like it has a chance of doing here. That's ARS Pharmaceutical. NRDY, I did buy just a tiny bit of this recently. You've got the golden cross. You've got a really nice green candle. It's been in this sideways period of consolidation, but a sideways period of consolidation above the 200-day moving average. And the CEO keeps buying more. And yeah, so I have one of my themes is the revenge of Cathie Wood for small cap tech stocks. I don't think this company is going to be as devastated by artificial intelligence as others. But we'll have to see what happens. But the founder and CEO just keeps on aggressively buying back stock, just non-stop. It's to the point where if the stock price doesn't rise soon, he'll take the whole company private, which I would not like because I want to have the benefit of its growth in the future. And let's see, SoFi, right? SoFi sold off hard on that Monday for tariffs. I think it fell about $1. And the joke was, geez, I didn't realize SoFi was exposed to Canadian timber or oil or maple syrup or things like that. But when things are trading at a high multiple, they can trade down with the market pretty easily. But it bounced back pretty well today. It's still in this sideways consolidation period, right around $15, $14 a share period. So again, it's that like so many of these stocks, you have this sort of bull flag pattern. You've got a period of consolidation after a huge run up. And then how many months does it have to move sideways before the next leg higher? I don't know. I was very surprised. So I think I bought in around the $7, $8 range, and I was very surprised when it ran up to $16. I thought it would run up a little more slowly. But the market seems to move faster and faster these days. So one of the reasons why I'll buy stocks in this sort of no man's land dead zone is I'm not always nimble enough after it breaks out to buy it before it's had its full run up. So I don't mind buying something that's been left for dead because I'm just not always fast enough to catch on to it while it's doing this thing. Let's see. Last one. This will be the last stock to talk about today. Centrus Energy. And it's the same thing as before. The bull flag and the consolidation. But this one might. Is that some higher highs and higher lows? This thing might be on the upswing again. So that would be. Right, there's that bull flag pattern, and this might be the start of the next upswing. It could be. The narrative on nuclear has been shifting so fast, but I think still you have the consensus being if you need base load power and you want it to be, if you're a Silicon Valley tech bro and you want it to be zero carbon or low carbon base load power, well, the nuclear is your only solution. The only downside is how many years it takes to actually build a new nuclear project. So then it's, well, okay, maybe there will be a natural gas power plant just for a few years while the nuclear plant gets built. But the solution could be, and if we have enough natural gas to last 100 years, then maybe natural gas is the answer. But I think that the narrative on nuclear has really shifted. Especially when you have people like Mark Andreessen and Mark Zuckerberg and all of the tech billionaires in Silicon Valley. They all seem to want their data centers powered with nuclear power. So I think this has a long, long runway in front of it. And yeah, it could be on the upswing again. Well, that's about all the time I have for today. Thank you guys for coming. This is not financial advice. I'm the Unemployed Value Degen. And yeah, I held off on doing one of these over the weekend just because the tariff situation, I think, was throwing a lot of chaos into the market. And I don't know if technicals work as well when we have all these Monday surprises from geopolitical risk. Anyway, thank you for listening, and I hope you guys have a great day.